So good afternoon, ladies and gentlemen. I do not know how excited you are, but I guess I am extremely excited to be in the presence of these two august co-panelists, Mr. Ramesh Damani and Vikas. I have had the privilege of knowing them for many years, but I was just before coming for this panel discussion, I was trying to list out what are the issues that we need to discuss. And I realized that Kanakji has been very unfair in slotting only 1 hour. We actually need one full day with them to just get an insight, because the topic for our discussion today is exponential wealth creation. And what better platform to learn about exponential wealth creation than from people who have exponentially created wealth. So apart from the introduction that Shekhari gave of these two gentlemen, there are certain nuggets that I will like to add. One of the things which is common to both of them is that it has not been a path which was very smooth from day one. Both of them learned by mistakes. I was reading about one of the old interactions or interviews of Rameshji, and I discovered that he was in the US initially, and his father gave him $10,000 with the instruction that he should invest it only in the US markets. And I think the condition given was that if he lost that money, no problem. If he made money, all of it was going to be his. I am told that Mr. Ramesh Damani promptly went and lost the entire $10,000. So that is how he learned. So today, for someone who's seen the rough with the shining path of the capital market, we have a lot to learn from him. And one of the key things which I very much admire about him is that many people manage money, but very few people are able to articulate their thought processes in the way that Ramesh is able to do. Many of you would have seen him on CNBC hosting a show which was exclusively his, where he has interacted with not just domestic fund managers but with global fund managers. So today we will also like to take advantage of the fact that he is a voracious reader, reads a wide variety of subject, and let me give you an insight. Today one of the key themes that we are talking about in the markets is defense. I don't know how many of you recall the first person who went public saying that he believes in the defense theme and has got into that was Rameshji, and that was 3 years back. So we have the privilege of trying to understand from him what are the secret sources that go into his analyzing themes, sectors that he is able to invest in. So we'll surely take advantage of that. Because those of us who are investors, most of us are obsessed only with the listed part of the equity market. Many few people know that Vikas is a versatile investment manager who dabbles both in the listed equity as well as in the unlisted equity space. For those of you who are from the eastern part of the country and more particularly from Calcutta, you would know that the Calcutta rolls, more specifically chicken rolls, are very famous. The same chicken rolls are known as kathi rolls in Delhi, and in Mumbai they are known as Frankies, and the brand name for that Frankie is Tibbs. Who owns Tibbs? Vikas. I actually got to see, in fact he also owns a very popular ice cream brand. I will try to elicit some of those nuggets in the course of our panel discussion. But the point that I am trying to tell you, and I think I heard the panel just before me, this all, even the privileged nature of the people present here who are on the, I would say, the upper crest of advisors and distributors, where you are now graduating from being just mutual fund distributors to other products and asset classes. I think there will be some insights that we will like to get from both of you on some direction for the people present here. But What I will also try to do is that, while I would like to hog and ask them all the questions myself, I know that, if I have 80 questions to ask them, there are 180 questions that you people want to ask them. So I limit the panel discussion to the more, I will say, broad aspects and leave some of the more, I will say, insightful things in your court for you to ask the panelists at the end of the discussion. But let me just throw the panel discussion open. I think one of the key things which is confronting, I think, most of the audience here, that we've seen a very beautiful run build up from the lows of COVID to 20,000 points plus of the Nifty. I think most people today are wondering that are we at the end of this bull run, or do we have more steam left in the market? And therefore, I leave that question as the opening question for both of you. You may please take it up in whichever manner you would like to.
So, I think, in my opinion, there's no two thoughts about it. What we have seen is just probably start of a very big bull run. I think India is in a very transformative stage. I say I haven't seen this kind of period for India in my 25 years of career, where everything is working together, a lot of things are coming into place. India has got structurally repaired on many counts. So long held problems which India had, whether it was taxation related, deep-rooted inefficiencies in everything, that have got plugged. Plus, India has built what we call a truly high productive digital economy. So, you've removed a lot of inefficiency, redundancy, and setting up the path for growth. So, last 5 years, if you see, or 2014 to 19, if you see, a lot of deep-rooted reforms were carried out. Right? GST, demonetization, IBC, RERA, all of them were pending for 30, 40, 50 years. Nothing was done, right? So that foundation stone was laid. Then and we were just recovering, IL&FS crisis happened. IL&FS crisis happened, we recovered from that, then we got into COVID. But all this foundation was laid. COVID actually became a very big catalyst for India because it also brought two additional, trigger, namely manufacturing and big growth in IT services. So now as we speak, India is the place where your banking sector is doing well, your manufacturing has started doing well, your services is doing well, infrastructure, we know that money is being spent on everything, road, railways, ports, airports, everything. Your real estate sector is doing very well. I haven't seen any period when we can say that so many sectors are doing well, and not only doing well, structurally from a next 10-15 years perspective, looking at a very and a lot of credit goes to, I think, transformation which undertook in last 5-7 years. So what we have seen is just, according to me, a trailer of a very long movie we'll see over the next 10 to 15 years. So I find it, one should not even worry about it and forget this is a real India story, right? In last 20 years, I remember in 2003, Nifty was 800 points. That's the time when I had joined Edelweiss. So 2002, it was 800 points. 20 years down the line, in Nifty is 20,000 almost. So you have had 22-23 times in 20 years, which is 17-18% CAGR. In this period, we have had what not? UPA 1, UPA 2, global financial crisis. We had 3G scam, coal scam, Fragile 5, demonetization, COVID, Ukraine war. You can name the kind of crises that happened. Despite that, India has delivered 17-18% return in last 20 years. I see no reason why India will not deliver more than this over the next 10-15 years, is my view. So, of course, volatility will be there. It never goes one way. And there will be, but journey is very long, so one should not even think about that. Is it a top of a bull market? And we'll talk more about it, why I don't see this in the system. But I will let sir comment.
Thank you, Vikas. Thank you, Sanjay, first for all the very kind words you said to me. I'm deeply humbled by that. Thank you, and lovely good morning to all of you. Lovely to be here. About 10-12 years ago, Sanjay, I was in a conference organized by the Tata Mutual Fund. And at that time, the topic of my presentation was Ab ki baar Sensex 50,000. I think now we're talking about Nifty being 50,000. So clearly, I think the bull market is intact. See, the bull market, to be honest with you, in my opinion, started in 2019 when the finance minister announced those dramatic tax cuts in corporate tax rates, going down 25%. During COVID, it went and tested that lows, in fact, even broke it, but that lows held and went back out there. So bull markets have their own rhythm, and I personally feel that whenever can it fizzle out in 6 months or 5 years, I'm not sure about that. But as you know, Sanjay, the market will give you advanced signals. Okay, there's a problem, there's too much leverage in the system, there's too much optimism in the system, there's too much heavy demand in the IPO market. All those will start signaling that the bull market is in trouble. Right now, we don't see any trouble in the bull market. We think, as Vikas correctly pointed out, the index is growing itself to 16-18%. You're add 2% more for dividends, and you develop money in every 3 years. Basically, you do a little better than the index. You know, so there's an extraordinary opportunity. And the question that everyone always asks me, and I'll take that elephant in the room first of all, they say, "Ki you guys are lucky. आप लोग इंडिया में 90 में आए थे, index 800 था. Today it's 60,000. Now you're telling us we're bullish." And very respectfully, like to suggest, with all the conviction that I have, is that the next 20-30 years are as exciting as the last 30 years in India. So not to be afraid if you miss the long-term great opportunity in India is the compounding story. You take a good asset, you can compound over long periods of time, you'll end up fairly wealthy. So I agree with Vikas that we are in a bull market. At some point the bull market will fade. All bull markets end. There's no such thing as a permanent bull market. So ये 6 महीने में होगा या 6 साल में होगा. Let's see. Let the market decide that. For now, remain invested. And here's the bigger point, that as he said, despite so many events taking place in the last 20 years in India, the index is still closer to its high than anywhere else. So remain invested.
Thank you. In fact, Ramesh and Vikas, you've actually set the tone for the discussion today. One of the sources of worry in the markets today is not to do with things domestic, but to do with things global. In fact, if you recount our worry points over the last 2-3 years, it has not come so much as to what India is doing, but as to whether the US is going to run into a recession, and if it is going to run into a recession, how are their markets going to perform, and more recently the way the G-Sec rates have spiked up in the US. So therefore, there are some worry signs that are coming from those shores rather than from domestic waters. How do we factor that into our investment decisions? Number one. Number two, do we really need to take them very seriously, or we can just take them in our stride and move on? Because in the later part of the discussion, I will also like to touch upon is to that the India of 2023. Is it the same as the India of 2008 when we had the last big crash, or the India of 2001 when we had the previous crash? A lot of things have changed structurally, but right now, the worries which are coming from the global shores, how serious are they, and how do we account for that in our decisions?
I'll start with this, Sanjay. What is the difference, of course, is between 2008 and 2000 tech bubble is what you all know. The Indian public has been buying stocks, so that the retail money is coming to the Indian stock market, which was always a fantasy for us. We always felt that why should FI tilt the balance in the Indian market when the Indian domestic pool of savings itself is so much? So I think this is long-term money. This is committed to India, understanding the benefits of investing in India, and there are enough examples of Rakesh Jumala becoming a billionaire and so many others doing so well in equity that everyone wants to be now part of the India growth story. So I think that is a qualitative difference, that even if it falls, I think money will come back, domestic money will come back to this thing. Should we be worried about load factors? Always. There's nothing, I would never say that let's not be worried about it, let's be so arrogant as to not worry about interest rates going higher or the Dow Jones falls. But I have learned, I think I said somewhere in your presentation, that you're volatility coaches. I think there's a difference between risk and volatility that investors always need to understand. I think risk is when you lose permanent capital in a business, and that's something that we are not very tolerant of, because you can't afford to lose permanent capital. Volatility is temporary changes in valuations of asset classes. That happens all the time. So if interest rates keep going up or oil prices keep going up, will the markets fall? Yes, they fall. That's no reason to sell. Great companies will find a way to get out of those traps. So my advice is that unless you think the bull market is ending in India, unless you very specific think that, in that case, of course, I would go into a little bit of cash, maybe 20-25% cash. But other than that, these are all factors that businesses have to negotiate.
So I think, in today's interconnected world, it is wrong to say that if something happens in US, nothing will happen in India. But the key thing to note is that what is the difference between 2008 and now? Partly Sir said that, on the retail flow side, but more importantly, if you just see, India is the only country post-2008 crisis whose debt-to-equity ratio, debt-to-GDP ratio has come down. Everywhere in the world it has gone up, right? So, risk हमेशा कहाँ से आता है? Biggest risk comes only from, or at a country level, generally at two things. One is at a leverage. Leverage always brings the risk up, right? Whether that risk is at the government level, corporate level, or household level. If you see on all three counts, today India is significantly under-leveraged. Corporates are hardly levered. Household loans are hardly there. Our government is hardly, debt to GDP or debt to government debt is hardly anything. So government is not levered, right? So that is a very big thing. What had happened in 2008, if you remember, entire corporate India had actually borrowed. If you remember, Tata had done 2 acquisitions of Chorus and JLR. Birla had done Novelis. So entire corporate India's almost 30-40% balance sheet was exposed overseas and had borrowed overseas. Secondly, entire banking system of India's banking system had also overseas exposure. So if we had written a very detailed note on that and post SVB crisis, that why this time around, if something happens in US, it will not have as much impact on India. So ICICI Bank's exposure in 2008 of the global balance sheet was almost 30 to 40%. Today it is less than 1%, 2%. So our banking sector is not exposed to the global economy. Our corporate India is not exposed to the global. Our corporate India is not borrowed from the global markets. So how the risk will come? So why it came in 2008? Because as they started unwinding balance sheet, all the stress both on the corporate balance sheet and banking balance sheet came. Today we are very, very well sorted on those counts. So if suppose something happens in the US, which can happen, as you rightly said, it's a very big risk, but we will not have the same cascading impact. We might have sentimental impact, but our economic impact will be limited. Our economy is not much levered to the US economy in a big way. The only two way our economy is linked is IT services, which today in fact is growing despite recession in US. Secondly, what we are saying, we are incrementally exporting more to US on the manufacturing side, which is a very big theme. There we are gaining market share from China. So even if US economy degrows, our growth of market share will come. So I think this time around, if there is a crisis, the impact will not be similar to how it was in 2008. And to that extent, it gives us comfort. But it will be wrong to say, if something happens in the US, markets will not be volatile. It will be. But impact won't be that. And it will recover probably far more faster than the rest of the markets.
I think it is very well articulated by both of them. Very well. Because this is the primary worry that I sense when I talk to advisors, when I talk to clients. I think with logical points, we need to understand that equity markets will never be in a situation where we will not have worries. What is important is that are those worries rational or are they irrational? I think what is coming out very clearly that yes, there are some risks on the horizon, but the response of the Indian markets and the response of the Indian economy to those risks will not be a replay of what we have seen in the past. I think that is a very clear guidance to us. Which brings me to the more here and now issue, which is again troubling the minds of a lot of advisors, I will say. I don't think it is troubling the minds of the clients so much. That has got to do with the mid and small cap space. There's been a lot of money that has come to mutual fund industry and more particularly to the mid and small cap funds. If you look at the portfolio rotation of the mutual fund managers, that doesn't seem to be indicating that with the new money they are churning out the old stocks and buying new ones. And as an investor, even I feel that there are now very limited choices of good stocks at attractive valuation. So there is a worry that is there in the minds of many people that the two major crashes, forget about the 1992 crash, but if you look at the dot-com bubble crash and the 2008, one thing was common, that most of the retail money started flowing into one area. Like in the dot-com, all the money started going into IT crashed. In 2007, all the money started going to infrastructure, and we saw the fall here. This time around, almost all the money is going to the small cap and the mid cap space. Is there a crisis building up there? And if so, how do we deal with that?
I don't think so. Simple point. I invest a lot in small cap and mid cap space. From what I can gather, where the bubbles are is perhaps in private equity. A lot of the valuations are very stretched out there, more stretched in secondary market. Sometimes in the SME section, maybe in the very micro caps, there's some sort of bubble building there. I can still put a portfolio of decent companies together at a fairly decent PE and a good 2%, 3% yield. So I'm not sure I buy that. Just because stock goes up doesn't mean it's in a bubble. It was extremely undervalued, so it got to some decent valuations. You look at how some of the larger banks in this country have performed. They've not been any returns for the last 3 years, 5 years, okay? But the reason they haven't given because everyone was buying those shares, they weren't buying the small cap stocks. The other reason was a lot of money has gone into what they call passive management. So the passive management buys only the index stocks, they weren't buying the small cap and the mid cap stocks. So obviously there's inherent value in those stocks. So personally I won't panic, I don't see any reason to panic in small cap and mid cap.
So again, I would say, we had written a very nice note on this called Small is Beautiful. It's there on our website, cardiniancapital.co.in. So when you want to buy, actually risk is where, in my opinion, it's a fallacy that small and mid caps are more risky. I don't think at all. Depends on what risk you are trying to manage. There are three kinds of risk. Type A risk is risk of permanent loss of capital. Type B risk is risk of mark to market or volatility. And type C is risk of opportunity loss, meaning better return, or risk of alpha. So if you are looking, sometimes in the mid and small cap, because of nature, type B risk is volatility risk could be high. But for people who are looking to invest money from 10 to 15, 20 years, what matters the most is there should not be permanent loss of capital, meaning type A risk should not be there. And type C risk meaning I should outperform the market, right? So small and mid cap is not risky. What is risky is bad business and bad management. So what I say or what we say internally, if I like a business and if I like a management, I would rather buy them small than big. If I like the business, if I like the management, I would rather buy them when they're small than buy the business, right? So when we launched our manufacturing fund in August 2020, 6 months after pandemic, a lot of people said, manufacturing are large cap, you are buying only small and mid cap. I said, manufacturing is such an early stage where you can only buy small and mid cap, where you will see large caps coming from the cap, right? So I would say that this is, depending on if you are worried about the short-term volatility of the portfolio, yes, small and mid caps are risky and you should manage your risk. But if you are worried about type A risk and type C risk, which is no permanent loss of capital and alpha creation, then small and mid cap over long term are far, far, far better. And I am not saying only from here. You can go and check this even last 20 years. History tells you that, right? So essentially, I would say focus on the kind of risk you want to manage rather than looking at so. I don't see, of course, there are some areas, some pockets where there is a froth which has got built, which I call euphoria, whether it is railway, defense, and there are pockets which are there. One has to be careful. If you go in a herd mentality in investing, of course, whether it is small, mid cap, large cap, we will find different kind of pockets. 2021 we had new tech euphoria, which was there even in the large caps also. Companies got valued at obscene price, right? So risk comes from very, very different. It is not in the cap as well, I would say.
I think this again I think is very well articulated because a lot of us have this worry about mid and small cap, and I think very well said that it is if it is the quality of the business and the quality of the management, and the moral of the story is it is always better to buy a business when it is small than to buy it when it is big. So I will take the cue from there and come back to Mr. Ramesh Damani, because he was one of the early ones to spot defense as a theme, a theme that is being talked about so much today. So we will try to take advantage of his exponential wealth creation and try to understand two things from you, sir. One is, how is it that you identified defense as a theme so early on? And from that learning, in today's context, what is it that we should be looking in spotting emerging themes? So we are trying to ask you the recipe of your secret sauce.
Thanks, Sanjay. Happy to share some of that with you. The first thing to make multi-baggers, you say, it has to be underwrote. It has to be unloved and underwrote. So, as you know, PSUs were completely underowned and underappreciated at the time. And I don't know if how many of you saw the recent Prime Minister's speech in Parliament, when he came and said in the floor of Parliament, he said, "Log jo PSU pe haste the, ab daam laga dijiye PSU pe." I mean, he actually said that. If you haven't go, please see it on YouTube. It's an extraordinary statement for the Prime Minister of the country to say in the well of Parliament. But he said that. Which leads me to 2 points, Sanjay. The first is that I personally feel, that every bull market has leadership. So let's say 92 bull market had cement share leadership, 2000 and technology leadership out there. This bull market, in my humble opinion, has leadership of public sector stocks. Okay? And people don't understand that. And when the Prime Minister comes in and endorses that gives me a lot of confidence in what I'm saying. So, why did I buy, for example, the defense PSU? Because it's cheap. I mean, I want to buy cheap stocks. I'm not interested in glamour, I'm not interested in being popular. I want the Nikas of the day or whatever the glamour stocks of the day. I want to make money, I want to compound my money, I want to buy cheap stocks. So you look at some of these stocks, they were available for basically less than cash value. They had 5-year visibility of earnings and they had 5% dividend yield. So even if they didn't work out, I would get 5% dividend yield. So I was willing to take a bet on that. So I think sometimes we equate popularity with being right, because you can talk in a party or you can talk in a wedding or talk in a social gathering that I bought whatever the stock flavor of the month is, and no one gets ever fired for buying, say, HDFC Bank. But there's a very hard truth that you didn't make money in Lever for 10-year period, you didn't make money in HDFC Bank for 10-year period. So you have to have the courage of your conviction and buy what is extremely unpopular, as long as you've done your homework. So to answer this point, one of my dearest friends who passed away was Rakesh Jhunjhunwala. And at some point he himself had turned negative on the public sector stocks. So I made 2 points to him. I said, first I've done my homework, so I understand what I bought, so that's fine. And second, I say, you can't be bullish on this government. You can't say that this government is going to change this country and then be not bullish on the companies that he's running. And when the Prime Minister came and said this, it kind of vindicated my thought process, that how can you be bullish on this country and the economy without the public sector, sometimes the commanding sector of the Indian economy. So I think, personally, if you ask me, I think while the stocks have run up and there's some flaws in it, I think they're probably going to lead this bull market. I would take you back to look at the bull markets of 92 or 2000. Take an exercise and see how much Infosys went up in 92, or how much ACC went up, or how much Abuja went up, how many times they went up out there. So that's the characteristic of bull market, that it takes stocks from extreme undervaluation to extreme overvaluation. Are we there yet? I don't think we are. Humbly, I don't think we are there yet.
Because I would ask you also to share, your experiences. You did mention that manufacturing was a sector that you spotted quite early on. So what is your recipe for the secret sauce that you have, and your learning you can share with the audience so that gives them some insight?
So again, first of all, I think in equity investing, one thing is you have to be a student, you have to be looking for evidences, you have to be looking for data, you have to connect dots, right? We launched manufacturing fund in 2020, on 6 months after pandemic. It came out of a very, of course, we've been looking at data. I've been watching the manufacturing sector from 2013. I believe that China was rebalancing since 2013. They are raising their labor cost. How can it happen that the country which is raising their labor cost from $200 to $800, and country like India, which is labor cost of $200, cannot benefit when this change is happening. So this was very big change happening in last 7-8 years, right? But in 2020, you know, it was a very freak thing that it came out of a conversation with an entrepreneur. I was talking to a company in Delhi. उससे मैं पूछा कि क्या हो रहा है, तो he said कि सब ठीक है यार, धंधा ठीक है, you know, order is good, but I'm not able to supply parts because they used to come from China. तो I said okay. Then he said, आपको एक interesting बात बताता हूँ, बोला बताइए. तो he said कि this part which I used to import from China, some steel part, you know, he said I gave it to a friend of mine. I forced him to make for me. Okay. जब बिल बन के आया, तो बोले पता चला वो चाइना से सस्ता है. And then he goes to make a statement कि यार पता ही नहीं चला चाइना का महंगा हो गया. So कहने का मतलब if 1,000 crore top line company के entrepreneur को पता नहीं चला चाइना महंगा कब हुआ. This statement made me, I spoke to 30 entrepreneurs, 30 companies separately, and everybody gave me different kind of nuggets around saying that how they are now going to benefit in China. So when I connected different dots, then I spoke to a McKinsey partner. Now this gave us so much conviction that this is a 10-year trend. This is not a like short-term trend. This trend which is left station. It is not going to be here for 2-3 years. This is like 10-15 years trend. Then we did a lot of work and we were quick to launch our fund in that. So invest in that fund, by the way, Sanjay has delivered 47% CAGR since last 3 years versus benchmark of 23%. So our stocks have become 6x, 5x in that period in that, right? So what I'm saying is, when you get this right, then you have to go with conviction, right? But if I were to say, you have to keep your eyes open, you have to, and when I launched, I'm giving this interesting part is that I spoke to a chemical company CEO. He said, you will fail in this. So sometimes within the industry, people don't believe there's a big trend there. When you look from outside, so of course you have to be optimistic in equity. I mean, you can always look that it has not worked, hence it will not work. Secondly, when you look at a broader trend, when you look at the collective wisdom, the advantage actually we have is that we speak to so many companies, you can connect it all. So there's a jigsaw puzzle you can kind of prepare very well when you speak to many people by connecting dots. So I think generally speaking, most of the themes have come out like this, that look at a macro thing and then go and identify best placed companies. I remember in 2013 when I came from Hong Kong, same thing on the manufacturing side, the chemicals will be a very big segment, and I had met a chemical company, Aarti Industries CEO and SRF CEO that time. Aarti Industries market cap that time was 400 crores, SRF market cap was 600 crores. And I came and went and told them, I think the chemical will do well over 10 years. They said in Gujarati, "Aukai nathi, but we will grow at 15-20%. So promoters in the industry could not see the trend, but now in last 10 years, SRF market cap has gone from 600 crores to 60,000 crores. Aarti Industries market cap has gone from 400 crores to almost now, after correction, also about 20,000 crores. And still, Pharma is out of it and still looking very good. So the trend when develops, as I was saying, that in a big trend, stocks can become 50x, 100x. When there is a tailwind, you have to just go and identify the right ship, sit on it, it will go far. How far? Nobody knows.
Right. So, one learning that I will take from both Ramesh and Vikas is, have you noticed one thing? They didn't talk about any jargon or any sophisticated tool that they use to identify the themes and sectors. I think what they did was simply two things. They simply looked at what they found interesting from the common sense perspective. I think you don't need to be very sophisticated in your analysis. Sometimes common sense works much more than any of these sophisticated tools. So that is number one. Number two that I infer from whatever I heard is that it may be very fashionable to go along with where everybody else is going, but it is important for you to keep your eyes and ears open. And as you discovered, sometimes even the industry insiders are not able to see the full potential. So I'm saying today as an advisor, you are in a far more advantageous position because you are looking at things from a bird's eye view. You are able to look at things from the common sense perspective, and I think that makes a lot of difference. So I think one one element of the secret sauce, at least we now know. So I will take this a little forward and ask them to share with us their own personal experience of where did they first created their exponential wealth. Which stock or which sector helped them create their exponential wealth, and are they still using the same elements in identifying where the next exponential wealth is going to come from. And we will not leave them at that. We will also, second part will be to share with us where do they think the next exponential wealth creation is going to come from.
I'm waiting for that answer, Sanjay, from you. Great question, Sanjay. I came to started this brokerage business in 89-90, became a member of the Bombay Stock Exchange. And at that time there was a big cement boom going on, cement boom chal raha tha. And I was an MBA from America, and I couldn't name a cement company in the world. I just couldn't name it because it was an unimportant business. When I was studying in America, no one talked about cement. You talked about tech, you talked about consumer, you talked about electronics, but no one talked about cement. And when I came to India, I realized that even my jobber and even my office trader knew the price of a bori of cement in Raipur. उनको भी मालूम था कि जयपुर में बढ़ गया कि यार ये, because I realized afterwards that we were in the middle of a cement boom, a cement froth, if you will. So that Harshil Mehta boom corrected after a period of time. But I was still very lot of despair that how am I going to make money? How do I compete with all these smart people who know the price of cement in a small town in India called Raipur? No, I didn't know that. But all of you heard Steve Jobs' name, I'm sure. But he makes a very interesting point. He says, your dots in your life will connect. You don't know where they'll connect. You've got to pay attention to where they'll connect. So in my previous avatar in the mid-80s, I was working as a computer programmer in America. I was an analyst in America, designing computer systems. As luck would happen to me, my two greatest winners early in my life were both computer-related stocks. When I came in '93, Infosys went public. This might come as a trivial question that will surprise you. Can anyone tell me what was the market cap of Infosys when it went public? Anyone has a guess out here? 800 crores? Yeah, what was the market cap over that price? Okay, anyone else take a guess? 800. It's now what, 5 lakh crores, 6 lakh crores, right? So think about what I'm saying.
200 crores.
Who said 50 crores? Who said 50 crores? Stand up. Who said 50 crores? Good, like, give him a round of applause. He's very close. It was 30 crores, believe it or not. It came public at 30 crores market cap. It had a 3 crore equity, 100 rupee price. So 30 crore market cap and went public at. So I understood that business, so we bought some, not a big amount, some amount of Infosys at IPO price. Then I started looking at computer companies in India because I knew them, and people said, tech में पैसा नहीं बनेगा, आप क्यों ले रहे हो इधर? कोई asset नहीं है, gross block नहीं है, लोग आते हैं, लोग जाते हैं, whatever. We bought this thing. And then I found a company called CMC, which is a public sector stock, right? Why did I find CMC? Because they designed the BSE trading system. I looked at the balance sheet, there were 30 crore rupees again. Something of that number, I guess, works. 30 crore में आपको CMC मिला था. I knew from my experience as a programmer that if I given IBM the contract to design the computer trading system of the Bombay Stock Exchange, they charge them $50 million, $100 million. You're getting $5 million this company, So those were two of my early. I mean, Infosys went up 2,000, 3,000x. CMC ultimately got merged with TCS, so it's also done very well for me. So those were some of the earlier successes I had. Again, the reason for success, they were underowned, they were underappreciated, and if you're first in them and get it right, sometimes a good fortune is awaiting you.
All of us, yes. Second part.
So again, I think I have a couple of them. I think I bought a company called KEI Industries when the market cap was 75 crores in 2012. I mean, I generally like large market cap, small market. I mean, it has 1,500 crore market revenue, 1,500 crore revenue and 75 crore market cap. And market had almost written them off. I had not known the company, I liked the guy, I had a business, and business was going with a transformation. Today it is almost close to 20,000 crores market cap. and I haven't sold any shares. So I believe in holding for long period of time. My longest holding is 20 years. So I mean, I generally don't sell stocks unless there's a reason for selling. So I mean, that's the. I remember when I was in AWS, in 1 year I got bonus, and entire bonus I put in a company called Ganesh Benzo, small company, 3 rupee shares. But huge asset base in JNPT, their tanks and all, which I think probably you can't replace. And today that stock is 180 or 90 rupees. But I've been holding that since then. So I hold stocks for a long time. Like I told you, Aarti, SRF, 2012. There were 400 crore market cap, 600 crore market cap. I continue to hold some of them. The largest one is recent one, which is public knowledge anyway, PTC Industries, which I bought in 2020 at 200 crore market cap. Now this is what defense has done. In 3 years it is 8,000 crore market cap. So, I never expected that. To be very frank, I have this feeling that, I always believe this. If there is a tailwind, identify the right ship, sit on it. You will go far. How far? Nobody knows. When I invest in any of these names I told you, I did not know how far they will go. I know that they will go far, and I'll sit on them. That's
I think that's where the insight lies, that it's probably easier to identify entry. It is difficult to predict your exit at the point of entry itself. Time is going to decide whether you will exit, if exit at all. Because from what we just heard, they're probably holding on to what their exponential wealth creators were.
And one more thing. A lot of time people say that actually money is not made in dips. So I have this specific example. I made every friend of mine buy KEI and Aarti Industries, these two stocks, at 30 rupees and at 40 rupees. I think stock almost doubled in a year's time. So most of them exited. Right? Because in 1 year, 100% return is a great return, right? Right? Agree or not? In 1 year, 100% return is a great return. Right?
So because you have a room full of 500 friends.
What I'm saying is that, so the point I'm trying to tell you is money is not made by knowing the names. That's the next tip. Money is not made by knowing the tips. I think all smart, Sargavi portfolio sabko pata hai. Every smart investor's portfolio, everybody knows. Money is made by holding and having own conviction. You can never make money on borrowed conviction. That is my view.
Now to in my opinion, the most difficult question. Today in the Indian markets, what are the opportunities that the Indian markets have not captured? The related question is, where do you see the next theme or the next exponential wealth creation opportunity likely to develop? We can for the time being ignore that the market will undergo some ups and downs because of macro factors. But if you leave that aside, where is it that there is an opportunity which we have not exploited, and how do we identify it?
I'll tell you two, which I think, in the public sector stocks we talk about, Sanjay, there's been what I call a rolling bull market. First, the defense moved up, then the railways moved up, then the banks are moving up, then maybe the power companies are moving up. So look at the other ones that have not moved up yet. I think there's still substantial amount of stocks there that can move up with them. In the private sector companies, again, because my son came back recently and joined the business from America, and he kind of actually helped me identify the PSUs again. So originally I bought all of them, he told me again, let's look at them, when I was not willing to look, so it helps to have a fresh pair of eyes. But he's been very bullish on the sports business in India. You can see the massive amount of money that IPL generates and how the leagues are becoming professionalized. So there's an opportunity sometimes, a lot of the IPL teams are at least quasi-listed. They're part of a listed company or they're trading in private. So some of them will over time become very, very valuable. If you look at the valuations of these teams in the NFL or the NBA in America, and you can in India, we have much bigger audiences than even they have. The revenues will catch up over a period of time as standard of living goes up. So in the private sector, I would think that the sports team, because just remember that I think there are 9 or 10 IPL teams in India, okay? Maybe 1 or 2 will be added in the next few years. But 12 billionaires will be only own 12 teams. You won't get a 13th team after that. It is so hard to win these assets. They are trophy assets. So always command a very significant premium. Right now you're getting them still at fairly decent prices. Okay? So if you look at next 10 years, I would say look at professional sports teams, that'll do well.
Very insightful. Thank you.
Again, I think probably beauty of this whole market or this growth is that it is very, very well diversified. I mean, you are seeing across banking, manufacturing, IT, infrastructure, real estate, across the board, and you will see newer and newer sector emerging. So according to me, I continue to remain very, very, very bullish on manufacturing. What we have seen is only a tip of iceberg. Our manufacturing GDP is still only 16%. So and government is targeting to take it to 25%. So if that happens, I think you will see, massive amount of wealth creation, and the newer and newer segments of, manufacturing are going to get opened, across, manufacturing, across, chemicals, in footwear manufacturing, toy manufacturing, garment, consumer electronics, across, and you will never, today, which is the toy manufacturing company, no? So, they will come about. So, in India, you will see newer and newer sectors opening up, and so manufacturing is a broader basket, and specifically import substitution or exports will do very, very well according to me. And then, the highest amount of money in terms of percentage, I think, will be made by this sector, and then newer and newer sectors will keep emerging. If I were to take probably 3 years view, I think pharma is coming out of a very, very 7-8 years bad period. You see, pharma stocks have not made any return in the last 10 years. Effectively, probably they will be at the same market cap. And there's a very fundamental change has happened. I mean, recently, FDA regulator was in India. In the US, there's a shortage of drugs right now. We don't have drugs. And India is one of the largest suppliers of drugs to US. Because last 5-7 years, US FDA regulator went very heavily on Indian companies. And because of that, a lot of Indian companies stopped selling, stopped producing, plants went out. This time around, last month, they were here for 10 days, giving comforts to Indian companies that, please do this, we will do this, we will support. Now this is now today, you have under-owned sector. Regulator saying, please banao, which was the biggest challenge of the sector. Now then you need to be a big brainy guy to figure out that what will happen in the sector. So according to me, and third, I think PSU banks, in my opinion, will do superly well. Most PSU banks will become 2x, 3x from here also in fullness of time. But having said that, I am telling you, in India, everything will do well.
It would be very selfish of me to keep on asking my questions. Let me give you a feedback, Kanakji, that when I told some of the people that I know that this is the panel discussion that I'm going to be moderating, many of your clients actually said that I'm willing to pay to attend this session. I think after hearing this, I think whatever we may have charged them would have been a understatement. Very valuable session. I will now leave the floor open to the audience. I'm quite sure you have a lot of questions. Shivali, can someone also come to assist me? Or do I? Yeah. One request. Please don't ask any stock-specific questions. Yeah.
I am also member of the Calcutta Stock Exchange and also other member of OTC Exchange. Because this exchange was established by UTI, mainly Dr. Dave, his brainchild, and after that total exchange is defunct. But I question to the Ramesh Damani, PSU shares, because all of my clients, everybody is now bullish about PSU share because price, their dividend, lot of dividend every time they're getting or RECPS, and every day the buying that again market will peak. Now my question is that the PSU share is totally depends on the government policy. You are aware our unit 64 scheme, our unit master account, everything was due to the PSU and government have to buy through SOS scheme. SOS scheme, Sanjay knows also. SOS scheme in the selling price. I have also seen in the year 2007, exact that time market was cash, but PSU government policy, the PSU issued 7 to 8% tax-free bond. I'm lucky that I'm holding some of the bonds that 8%, 7.5%. Actually, my effective yield is 13% because last 20 years to keep the return of 20%, 5% is not possible given the equity market. My last question is that whether PSU are extreme bullish or not, that because that price, because price is very high. So for that reason, I'm just asking my question. That's it.
Thank you so much. I believe, like I told you earlier, that PSUs will lead this bull market higher. So you may not want to buy the most expensive PSU right now, but there are a lot of PSUs that are available at 8 times earnings, 10 times earnings, 5% a year. I think they will do well. Generally, when a sector moves, the entire sector moves. So I would remain bullish on it. I might have changed from A PSU to B PSU, but overall I'm well invested in PSU. I cannot tell you what I'm doing.
Good afternoon, sir. This is Rajesh from Delhi. Thank you very much for enlightening us with a lot of new ideas, the way we should look at the market, and explaining very well the global risk which people who are fearing about how the US is going to affect it. My just one small question to Mr. Vikas, to both of you, like how we should look at the risk of the political risk of the ensuing election in 2024. Is there any political uncertainty, or if something happens, how we should react as an MFD to our investors? How should we prepare our portfolio before the election? And a lot of our investors are worrying to take out some money before the election results. Is it really a risk, or if it happens, let's suppose Mr. Modi does not come to power or BJP loses, how is the market going to react? Thank you, sir.
आपको याद है जब UPA आया था, the market was down 10-20% at that time. I remember it was down 10-20%. This is in 2000 somewhere. 2001 UPA won, and all the PSU stocks were down, all that. And then the market recovered and the index went to 20,000 during the same UPA tenure, So governments will come and go. I mean, what I have learned is you remain invested in India. I mean, my simple suggestion is, we can't calculate the political risk. We're not astrologists. I can't calculate the political risk. Yes, there'll be some trading opportunities for people to understand, but a good business will find a way to make money through UPA government, NDA government, India government, whatever you have. So I would say ignore the political risk and remain invested.
Of course, what Mr. Modi has done is transform the country, and he's put on. We have seen G20 and all those things. So, and if this same leadership continues, which I have full reason to believe that it will continue, but politics is politics, you never know. So, if he continues, I think India has a great future. If something else comes up, we might have a short-term hiatus, but long-term opportunity remains. But yes, we definitely need up ki baar fir Modi sarkar.
Hello sir, this is Naveen from Bangalore. So this question for both Damani ji and Vikas ji. Last 2 decades we have seen that when the corrections are happening, they are not for longer duration. So all the investors are bullish and even the recovery is very faster. So I'm asking this question in perspective to fund. So is it buy and hold is better rather than timing the market in the fund, so that we can avoid the long-term capital gains and other thing? This is my first question. Second thing is that what is the new thing, a new reading you are doing, which is which might be helpful for us. Damani ji has shared a lot of details about this in masterclass with super investors. So some more things can be added. It will be really helpful for us.
So I think of course buy and hold works. I again would say that the reason why corrections are very sharp is because the underlying economic resilience is very high. I think so many sectors are doing well, right? And economy is doing very well. Secondly, today, because of the lot of transformation of the economy, today the financialization of savings has been happening. Very few people now invest into real estate, including the cash money which we used to have started coming into the main system. So today also we are significantly underinvested into equities as a financial household savings, so less than 5%, right? And US is about 35-40%, right? So even if you think journey is long way. Secondly, even if you look at, forget domestic savings, international savings. See, India is the only market which is doing so well across the global economies. India is still very poorly represented in global investing portfolios. So I see a scenario in the next 3 to 5 years. Today, right now, because Fed rates are very high, flows are limited, but the moment that peaks out, which can happen 6 months, 9 months, nobody knows, but it will happen in the next 3 years for sure. When that peaks out and start coming down, I make this statement very sort of seriously, that there will be an avalanche of capital. We have still not seen any capital coming from global flows, and over the next 3 years, we will see a lot more money coming than we lost $45 billion in the last 3 years. We have got only $5-6 billion. Much more than $45 billion will get that. So just imagine what will happen. And today also in India, a lot of businesses, a lot of large rich families who sell businesses. We read every day in the newspaper that this business got sold for 3,000 crore. Now where does that money go? The promoters who are selling business, where does that money go? It comes back into the markets. A lot of them are still sitting on cash and interest. So every time there's a fall, a lot of money is waiting to be invested because the faith is there in the market for now. So I see a situation in the next 3-4 years. In fact, we will have a huge euphoria getting built because of liquidity. So hence the corrections are kind of going to be short-lived and short-lasting in my opinion.
Sir, this is Rakesh from Coimbatore. I have met you, both of you, sir. I have been invested in this market since 1990s during my school days, and I have made for my family wealth by staying invested. I have seen 60% market fall, all the 1993, 1999, 2007 and 2020. Now my question is that I have also kept stocks for a very longer time, Adani since the IPO, Kotak Mahindra Bank, SBI, many of the stocks still holding and made huge returns. I want to ask you from the fund, mutual funds angle as well as from the stock angles, that sometimes, as you told, Ganesh Benzoplast, I am also holding many. Atul SRF bought at 100 rupees, 70 rupees, holding still. Atul went up to 10,000 rupees, it corrected to 7,000 rupees. After that consolidation phase, what do? Do you still hold? We should still hold if the businesses are good, because it goes for the consolidation any business for 3-5 years. During that time, what should we do as an investor and for my customers also? I would like to know.
From both business goes one way, no stock up goes one way. There will be periods in 10 years, 30% drawdowns, right? I have seen most of my stocks have gone 30-40% from the places where there's every business, as long as you know the management, you like the business and like the management, at least, and the sector is doing well, I believe it will continue to remain invested. In fact, those consolidation periods are periods of investing further if you have more. So at least I don't worry about those no return period.
I agree with it. If it's a good business, I won't sell it for love or money. I want to hold on.
Sir, very good morning. Good afternoon, in fact.
I think this will be the last question.
My name is Gaurav Jain and I'm from Lucknow. Sir, as an investor, one of the most difficult things is to manage your own emotions and behavior, and especially at the levels that you deal in, where you're putting in not a few hundreds but maybe a few thousands of crores, both your own money and for investors' money. What is the process you follow when it comes to holding on to your emotions? Because it is very difficult to hold on to your conviction when the stakes are so high. We talked about a few stocks when they went up. The human tendency is chalo profit book kar lete hain, kuch to milega. But you can't stay like, sitting on a dinosaur's egg for 20, 30, 50 years and waiting for it to hatch. What's the process you follow to control and manage your emotions?
Yeah, great question, of course. But I'll just say 2 tricks which I use, Gautam. What I try to do is I try to take the emotion out from the individual up and down in my portfolio. See, I'm an individual investor. I don't invest for anybody else other than my family. And to my own benchmarking, whatever happens to individual stock, is my portfolio doubling every 3 years. It's about 20 to 23% compounded. If it does that, in between stocks will go up and down. I lose money in stocks and make money, that's fine, I can deal with it. So that's what I try to do, to test myself. That is, my portfolio doubled every 3 years. If it's done, I don't really care, I'm doing the right thing. I don't really care what anyone tells me. I'm doing the right thing. Second thing, the most important thing I'll tell you about investing, as you said, Warren Buffett. What is important in investing is not IQ. You don't need a very high IQ in this business. What you need is the right temperament. Okay? How to buy when others are selling, how to hold on to stocks, how to not get rattled. Or if you make 3 times your money, you say, बहुत पैसा बन गया, अरे 5 गुना बन सकता है, 20 गुना बन सकता है. So try and develop the temperament that you need in this business. Warren Buffett, I think he explains it much better than I can to you. But on an individual level, to take out this thing of some stock going down, profit going up and down, are you broadly on track of doubling every 3 years? If you are doing it, you're doing a great job. If not, tail it a little bit so you're getting that. From the base level you're starting with, you have an opportunity to do that. It's very hard to do that as the base increases. But most of us start from a very small base. From that base, it's very easy in a market like India to double your money every 3 years.
No, I think I agree with you, sir. And one thing which works very well, I think all of us, or most of us, or some of us, we see portfolio value every day, or stocks every day. I mean, we assign our value to the portfolio value. And I think that is the most, if market goes down, so today if my value is 100 crores and tomorrow markets go down for some reason and it becomes 90 crores, I become very restless. And that is the start of the, sort of downward. So, as long as, you don't mark to market yourself and assign your success and failure based on that, and you look at 10-year journey, I'm telling you, and people don't believe when I say this, I don't know stock price of many stocks, of my portfolio. I mean, I don't know. I don't, and including not only our money, third party money also, because ultimately what am I going to do with it if I bought something for 10 years? क्या होगा अगर वो आज उसका भाव बढ़ने से हो गया तो? And I am into markets. I can tell you, I don't watch stock prices through the day. When somebody asks for meeting at 11 o'clock, say, can I come market hours, will you meet? I say, why not? I have nothing to do market hour with the markets. So my point is that actually investing is a lot about behavior than lot of hardcore knowledge. Of course you need sector, you need to have study and basic knowledge, but it's not like you need a lot of IQ. And I can say that we write a lot of things about these behavioral aspects, some of the stuff I would strongly recommend you to subscribe to our letters on carneliancapital.co.in. Lot of behavioral, we have written a lot of stuff around behavioral part of the investing. You will find some insightful one. No, the website name is carneliancapital.co.in. That's a firm which I manage. So we write, you will find in the letter section a lot of stuff written on that. And many of the questions are also covered in that. And some of the stuff which I have spoken is also covered in that.
So last question of the day.
Yeah, my name is Krishan. One question I want to ask the audience, if you permit me, and one question to the panel. It's a bit uncomfortable question. I have not seen any country growing with a higher GDP growth rate with rising unemployment. Don't you see a risk for India? One. I see in India that nominal GDP growth rate is falling, but your real GDP growth is rising. What does it mean? It means that there is some disconnect between your expenditure method and income method. So if your nominal GDP growth is falling, what you see, what kind of GDP growth India will give in next 10 years? Number one. Number two, do you see relation between GDP growth and markets? If you don't see any relation, stocks can give you return. Yes, it can happen. GDP doesn't grow, markets can give you return. It can happen that GDP grows. Take the case of China, stocks doesn't give return. The first question, the only question I want to understand is why nominal GDP is falling, the growth rate is falling, whereas the real GDP growth rate is rising. Is there a disconnect? This is the question I want to ask. Number one. Number two, this country is growing at a very good GDP growth rate, but with rising unemployment. Will it pose a challenge to the so-called, what can create a kind of a social unrest?
So let me first think about the rising unemployment. I think, very often, depending again which side of the political, one will say,
there's no politics in this. Answer numbers.
Let me answer.
Last year, 4.14 crore graduates have come out. Highest ever after independence, right? Will this kind of...
We are the highest population ever after independence.
That's
Can I answer?
Question is simple. Question is very simple because I couldn't articulate the question properly. Last year, 4.14 graduates have qualified from colleges, right? At 7% GDP growth rate. And again, the GDP growth rate, where the nominal GDP growth rate is falling.
I got your question.
Can you create that kind of employment?
I get your question.
Yeah.
So point I am saying is that in any, whether it is economy or investing, what matters is the rate of change. Okay, what determines is the rate of change. Is India is going to get full employment? Probably may not be in my lifetime. Okay. Are we employing more people than last year? Answer is yes. Okay. Let me give you example by that. IT has employed more people in last 2 years than they deployed more put together in last 10 years. Is that not employment? Now government releases the data. The PF accounts data, how many PF accounts have got opened? You know, I don't remember the number right now. But the PF account opening is a good indication of the employment, new PF accounts, right? Right? You see last 3-4 years or 5 years history, that number of PF accounts are opening up. Number 4, sectors like manufacturing, sectors like real estate, sectors like when they grow, what do they do? Generate employment. You go and talk to any businessman, number one problem they are facing is manpower. The point I am trying to tell you that you can make an argument that India is unemployment. Yes, India unemployment, if it was X, today it is definitely 0.8x. Now does that mean that India's employment problem is solved? Answer is no. Same way, like India is a poor country, we have poverty, people still below poverty line. But does that mean that even if we have grown as an economy, our number of people below poverty line has gone down? So, in investing in wealth creation, what matters is not the absolute state, the rate of change. And that rate of change is definitely positive, number one. The real difference between, second question you asked is the difference between real and economic, is inflation. Today, India has managed inflation the best in the world. I mean, we must give huge amount of kudos to this government for managing inflation. Every country is talking to it. I have a core philosophy saying that it's very difficult to assign value to the accidents avoided. We all know when accident happens, kitna value is that. Do we realize in last 15-20 years no terrorist attacks have happened? Do we know what is the value of that versus what is that? So it is very difficult to know when we have managed inflation well, we must appreciate that. The real differences between that. Last question between China versus India. See, the setup of the Indian economy is very, very different than China. China is a controlled economy. China has created wealth in form of what? China has created wealth in form of their forex reserves. They have sitting $3 trillion. They don't care market cap because it's a controlled economy. India has created because it's an open market, open democracy, with law and system in place. Ours is a far more and more like a US economy. So if you see what happened in the 1980s in US, when their economy went from $2 trillion to $5 trillion, they had a massive amount of wealth creation cycle. Right? I see, at least my view, and I may be wrong, so everybody can have their own views. We see similar kind of wealth creation happening in that next 10 year, 15 year kind of period. So ultimately I would always say that there will be problems around. In democracy, there will be noise. We will read negative news every single day. But what matters is keep in mind rate of change.
Thank you, Sanjay sir, for moderating the panel. Thank you, esteemed panelists, for being here. To express our appreciation, I would like to call on stage Mr. Rahul Chandalia, Mr. Sagar Panchal, and Mr. Opinder Jain. Come forward and present the ceremony. These mementos symbolize our respect for the dedication and contributions of the industry. We have a huge round of applause, please. insights. Now it's time for a well-deserved lunch break. We encourage you to take this opportunity to recharge and refuel for the afternoon sessions. Please make sure you return promptly as we have more exciting presentations in line for you. Thank you so much.